You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. My name's Trent Fleskins, your host as always, and it's the episode that a lot of people have been asking for. It's our budget response on the Perth Property Show. Spent a couple of weeks mulling over the changes, especially to trust, CGT, and negative gearing. And instead of just rolling this out with another property guy, we thought we'd do something that not many people are actually doing in the property podcast space, and that's getting their tax guy on, because it's actually a tax issue. Let's talk tax. Carlo Bordi from Bordi & Associates, thanks for coming back on, mate.
Oh, you're welcome.
This budget is right up your alley, isn't it? Because they've had a real crack, whether it's been good or bad. The future will really determine this, whether it makes much of a difference or not.
Look, yes, I did buy my Panadol last week and I got about 20 packets because we're going to need it. This is really bad news for a lot of people, but we'll go through the exercise. But I suppose what you've got to keep in mind is that it hasn't passed legislation yet. But look, let's work with what we've got and we'll see where it pans out.
So you say really bad news. I'm less concerned, to be honest, because I'm not sure it materially moves the dial on a lot of people's investment decisions. I think it does start to augment where supply and demand will shift to, but I don't think it's going to impact demand or supply broadly across the market in property. I don't think it's going to bring that many people out of demanding property in the market and send it to shares or superannuation or starting a new business, especially given the broader CGT implications of business ownership and sale that we've been seeing memed all across LinkedIn right now. And so I think the devil's in the detail about the rule changes to the game, but I think most people are still going to want to play this game. So let's really nut it out now and get through the weeds. I think we should probably start with CGT, because it's probably the simplest one to get our head around for starters. Now, what we know is prior to the Costello-Howard era, the Keating plan used indexation as their basis for discounting any CGT taxation. From there, Costello has essentially gone, this is all a bit too hard. We want to incentivize things a bit more to get some more supply. We're just going to make it a flat 50%, which we've been dealing with for the last quarter of a century. Is that an easy way of explaining it?
Yeah, it was just basically an inflation calculation. Didn't give people a lot of discount, but it was something that was better than nothing.
Now, what the opinion seems to be from the Labor government and people on the left side of the coin is that 50% is over and above inflation. It's too generous. It's too incentivizing for people to want to therefore go and buy 1, 2, 3, 4, 20 houses, of which they probably don't need to own, and therefore we're going to roll that back, make it less of an incentive to invest in property as a mum and dad, and therefore less of a crowding out effect on first home buyers who are already materially disadvantaged given their lack of experience and lack of savings in the first place, so that they can have a crack, right? So what they're doing is they're bringing it back to the pre-Costello-Howard era, bringing it back to the Keating era of looking at it, and simply just indexing it back to inflation, right?
Correct, basically an inflation calculation which gave some relief from capital gains. The inflation calculation won't be starting straight away. These new legislations, assuming they get passed, will start on the 1st of July 2027. Now just understand who it'll affect. If you today or tomorrow buy a new residential property, it has to be new, you still got the advantage of claiming the 50% discount moving forward, or you can use the indexation. I think you'd be a fool to use indexation, but that's an option you'll have. While anyone that has had a house before the budget won't have that privilege. So you'll have to then allow for the twofold calculation.
Now that twofold is essentially everything up to 2027 is grandfathered to any value up to that point being attributed at the 50% discount, and then everything after that, indexation. How do they work that out? Is it a time-based thing? Is it a get evaluation on the 1st of July 2027? What are they doing there?
At the end of the day, the ATO have said, we've got an easy formula for you if you want to use it. Now, as soon as the tax department says that, it means it's to their advantage, okay? And to give an example on what they refer to there is that if you bought a house in 2020 and you then sell it in 2030, you virtually had it for 10 years. Now, the legislation is effective from the 1st of July 27, so that means you've had it for 7 years before this legislation and 3 years after the legislation. So there'll be a pro-rating of the gain over that period, and then it'll be calculated on the 50% for part of it and on the inflation on the other part. Alternatively, what we're going to be strongly recommending to people is that they use a licensed valuer, they get a proper market valuation as of the value of the property on the 30th of June 2027, and that'll give you your accurate cost base. And I think in most cases, people are going to be far better off if they sell their property after that date.
So that's an opportunity, is it? We can get a valuation from a licensed valuer and say, hey, we don't want to do the 70-30 rule here across that 10-year period, being 7 years, 50% discount, and 3 years inflation indexation. We want you to use this valuation as of the 1st of July because it actually is more accurate and it benefits us. How would it benefit us? I assume because the value is obviously different compared to the 70% apportionment.
Think of it this way. If you've owned a property for 30 years and then you sell it in 2030, if you have to prorata the gain that's done, it would have made most of its gain
in the 27 years before.
Yeah, exactly right. So
you want that 50% discount to be against most of the gain.
Absolutely correct. Spot on.
Yeah. Now, obviously that 27 years is already 90% of it. So if you believe that the gain before 2027 was more than 90% of your gain, you would get a valuation.
What I'm going to propose is that people should get the valuation, and that will then allow your accountant to give you the outcome of both. Now, if it's going to cost you $500-600 to get the valuation, one, it'll be deductible, but two, more importantly, it could be significant savings by using that option of either one or the other.
Can we use an example where you actually have a look going forward into the future for someone who's buying an investment property from the 1st of July 2027, so no grandfathering of the 50% from previous to that date, as to what this change will do for their ability? And this is a big part of that whole intergenerational equity situation. Is this Labor government's put this out there saying we're trying to shift money from rich older people to give younger people a hand, but the criticism has been, well, hang on a second, these rich older people already have their properties, you're grandfathering all their existing assets anyway, and what you're saying is that young people now who are just starting their investment journey, they've got a far less lucrative situation to be able to work with in terms of their wealth creation through property investment. What would that difference look like, Carlo? Someone who's making a certain amount of money from the 1st of July 2027 under the old scheme versus the new scheme.
The biggest difference that relates to this situation is that, and this sounds bad, but the reality is the more you make out of it, the less that you're going to be impacted by the new legislation. So if your gain is huge, if you're making, for example, $130,000 in capital gain, which is taxable gain, and you've got no other income, under this new method, which will be a flat 30% tax on that gain, you'll be paying $39,000 in tax. Compared to under the old system, you would have paid $34,000 in tax, so you're paying about $5,000 more. Now, is that going to sway you to make a decision as to what you're going to do, whether hold it and sell it before this legislation? Probably not.
Yeah, I would have thought at the end of the day, if someone said to me, Trent, you're going to invest in property on the 1st of July 2027, and at some point in the future, you're going to make $130,000 in capital gains, and you would have paid $34,000 in tax based on the 50% discount, but now you're going to pay $39,000. Is that going to change your decision to invest that property in Morley? I probably would say no. I'd probably still do it, Carlo, to be honest. It's $5,000 more that I have to pay Elbow, but it's still $80-something thousand in my pocket.
I agree. But let's look at another side of it. Pretend you're a pensioner and you're making a $15,000 capital gain, and you're only on pension, you're earning another income. Under normal circumstances with the old legislation, you'd be paying nothing in tax.
Because you're below the tax-free threshold
of $18,600. And pensioners actually get more concession than that. They can actually earn about $30,000 because they get other discounts. But under the new legislation, it's going to cost them $4,500 in tax.
And is that because of the 30% minimum tax included in this whole indexation conversation?
With part of the new changes, all capital gains are all going to be taxed at a minimum of 30%.
So you can index it all you like, but if the number's still lower than 30%, we're still going to tax you 30%.
Correct.
See, I think that's actually more impactful out of this conversation than the difference between the 50% discount and indexation. Because as you said in that previous example, the difference is, to be honest, not changing my mind about whether I buy that townhouse in Doubleview, the $5,000 difference across $130,000 in profit. But it does start to make a difference as the tax scales get lower and the minimum tax scale sits at 30%. So what you're saying is, if you're making money through your salary, through an income, you've got different tax scales of your tax-free threshold, your 18%, ratcheting up. But if you're making profits through capital gains, then it starts at 30%, regardless of whether you've made a lot of money or not.
Correct.
Yeah, see, that starts to push people away from investing in anything, let alone property, shares, a new business, people can start to go, hang on a second, I didn't even do that well on this and I'm still having to pay 30%? That's not very competitive internationally, is it?
Look, we're not going to look attractive at all. In fact, the other side to this is that with trusts, and that's going to make it even more detrimental. So you have to completely rethink the way you're going to be purchasing property moving forward, not to get stung in the tail with this.
Okay, so before we move to negative gearing, let's talk about trusts for a second, because it does talk to how we distribute our income. A lot of small business owners and a lot of property developers, they will invest with a trust. Yeah, they will buy a property in their name on behalf of a discretionary trust. So it might be Trent Fleskens as trustee for the Fleskens Family Trust, or we might buy it through a company, Fleskens Pty Ltd, as trustee for the Fleskens Family Trust. Yeah?
Yes, absolutely.
Yeah. Now, irrespective of negative gearing, which is different across those two examples, and we'll talk about that soon, the benefit of a trust has been in the past that whether you make money in the business and it's a husband and wife and the husband works on the business and the wife is at home, but really it's a family unit. If you made $180,000 that year in the business, instead of paying that $180,000 all through the husband and the wife made nothing, the money goes to the trust and you both make 90 and therefore you're both on a lower tax rate, right? It's exactly the same with property, isn't it? If you made a capital gain that year of 180, you can split that equally between the two of you, 90 and 90, and your tax rate would effectively be lower than if one person made 180. Is that true?
Absolutely. But also, the trust gave the ability to use a capital gains discount as well. With a company, you don't get that discount. So normally what we'd say to people is, never buy properties through a company structure. You don't get any discount when you sell the property, and the company's still going to be paying tax at 30 cents in the dollar. And then when it goes in your name, you might be in a high tax bracket. So you lose out, basically.
So buy it in your personal name because you can get the 50% discount.
Either in your personal name or through a trust.
So your personal name or in your personal name as trustee for a trust, because either way you would get a discount.
The discount would apply. But by having the trust, you had flexibility to distribute to your spouse who might be in a lower tax bracket than you.
Yeah, so now you can still distribute to your spouse, but the minimum tax rate is going to be 30%, which is as if their income was what?
To be in a break-even scenario, with regards to this 30% tax that applies to trusts, you are no worse off if you're earning about $190,000.
So this confuses the shit out of me here. The whole point of this was supposed to make intergenerational wealth more equitable, right? Was to help the middle class, help the younger person out from the older, richer person. What it seems like is that it doesn't affect anyone who's making a lot of money in the first place, because they were already on the higher tax brackets. They were already on 30%. They were already investing through companies and corporate trustee structures. So all of that stuff is really irrelevant to rich people, and it's taking from the middle class who were using these opportunities, you could call them loopholes even, to try and minimize their tax in the first place. Does that sound about right, Carlo?
And unfortunately, the less you earn, the more of a slap in the face you're going to get. So, yeah, most definitely.
So it's counterproductive, really.
For what they were proposing and the way they presented it, they haven't presented all the facts.
It sounds like, yeah, the ideas they had have not actually translated into how it's going to come out in the wash. Let's look at negative gearing as well now. Negative gearing obviously is a situation for those who are a bit confused about it, where if I own an investment property and my expenses are 100 grand a year, but my rental income is only 70 grand a year, well, I've lost $30,000 that year. And if my marginal tax rate on the rest of my income is about 33%, let's call it, then I'll get 10 grand of my tax back, deducting off this $30,000 loss. Yeah?
Yeah, basically you can offset your loss against other income. That's probably the best way to understand it.
So for example, if it's the other way and your rent income was 100 grand, but your expenses from insurance and interest, etc., was only 70, then you made a $30,000 profit. You'll pay tax on that profit in the year, right?
Correct.
So negative gearing doesn't even apply to anyone that is actually positively geared, right?
Yeah, negative gearing is basically you're losing money on your rental property, which excludes principal repayment on your loan.
Yeah, and it's a tax shield. It's a bit of cash back on your loss for the year. It's just like how you run a business, right? So it's applying to those people who are losing money, who are negatively geared, which is not everyone in the market in the first place. There's a lot of people in Perth who have owned their property for more than a couple of years that are now positively geared, whose loan is lower, whose rent is higher. Rents have gone up by 90% in the last 6 years, Carlo. There's a lot of people who aren't even negatively gearing anymore because they're positively geared. But let's say you are negatively gearing What they're essentially saying is that for any established properties that you buy from now on, you're not going to be able to use that negative gearing. You're not going to be able to get that 10 grand back off the 30 grand you lost this year. But for all the properties that people already own that are negatively geared, you're going to be able to keep negatively gearing those ones. The only exception to that is new builds. Yeah.
Correct.
So what they're trying to say is, look, we want to get rid of this thing, but we still want new supply. So we're still going to give you this incentive on new supply. What they're trying to do is divert that investment from crowding out first home buyers in the established market and push them out to the new builds, which are mainly on the urban fringes and in Perth, some apartments. Is that right?
Yeah, well, two advantages in buying new builds after the budget will be, one, yes, if it's negatively geared, you can claim that. Now, that loss can either be applied to future years when that property starts making money, because as you said, your loans go down over time, or if you haven't absorbed it all that way, it can be reduced against your capital gain. But the other significant difference is that when you buy the new residential after budget night, you've got the choice of still applying the 50% discount on that purchase when it's sold later on.
So what you're saying is not only is the exemption applying to the negative gearing, it also applies to 50% discount. So the 50% discount still exists, but only for new builds.
Correct.
Yeah, so you can see what the Labor government's trying to do. They're trying to incentivise investors who are always going to invest in property, whether it's established or apartments or new houses, and they're essentially just trying to say, hey, look, we're not going to help you out here on the established anymore, so you may as well just look at the new build stuff. The impact that will have is that it will divert some investment and some capital towards new builds. There will be these house and land spruikers out there who will reshape their model to say, hey, you still get your negative gearing, you still get your capital gains tax, so come to us in the house and land space. It'll go towards apartments. So it'll have some impact on creating new supply on the urban fringes. Interestingly, I think what it will do, though, it'll also start to dry up the supply of investment properties in the established inner ring suburbs. However, that's not going to stop people demanding somewhere to live in somewhere like Inglewood, for example, right? If I'm someone who can't afford to buy and I want to rent, I want to live in Inglewood, it means that over time there's going to be less rentals available in Inglewood, doesn't it? Because less people will be incentivized to invest in Inglewood rather than Ellenbrook.
Oh, one of the strategies that we always used to propose to clients is saying, if you would like to live in a suburb that you can't afford to live in now, buy a rental property there, and then you can always vacate the tenant when you're ready and you can move in, and they've helped fund that property for you. Virtually now, that won't work.
So there is actually another negative for young people who were doing that rent vesting idea, as you said, getting the serviceability to buy into the location that they eventually want to live in with proposed rent, just to get in now and then still living at home or renting in a less desirable area and then one day moving into that house in Inglewood. What you're saying there is not only are the rentals not available, but also the protection from a cash flow perspective to set yourself up by rent vesting into an area that you might want to live in one day has also gone.
Yes, and it even gets worse. I read an article this morning that the lending institutions are looking at potentially lending you 20% less because before where you got the deduction for the negative gearing, your cash flow is not as good anymore, so they're not going to lend you as much.
Yeah, so what it does is, again, it funnels that supply towards the urban fringe. And that's a really interesting space. What I think it's going to do is it's going to put supply pressure or under-supply pressure in the established markets. So the price of property in places you'd rather live will be protected from a downside perspective because there will just be less people providing new supply of rentals in that area and less investments in that area. Before you do an infill subdivision, it's an investment, you're negatively gearing. And so less opportunities for new supply in the established areas, and there'll be more supply driven towards urban fringes and apartments.
Because that's where the new houses are going to be built.
Yeah.
Yep.
Interestingly, what that will do is mean that rents will go up in the established areas, and maybe we'll get to a point in the future where, regardless of whether there's negative gearing or not, yields will be so high in the inner city areas that investors will come back into those areas simply for the yields because it will just be positively geared because it's so undersupplied in the rental space and they won't even have to worry about negative gearing. Have you thought about it that far?
Oh, look, absolutely. And they'll also be buying the properties in either their individual names or potentially a company structure.
So let's segue to that, Carlo. What you said before is that most of the advice previously for unsophisticated mum and dads was, hey, don't bother with a company structure. It costs too much to do accounting. We're going to charge you money to keep it going. ASIC will charge you for reporting. Just go in your personal name because you'll get your 50% discount, your negative gearing, right? Now, more sophisticated investors, developers, they will use company structures anyway for asset protection, for splitting up their developments. All of our developments at Strategic have been in companies for years. We don't get any of the 50% discount. We don't get any negative gearing. It's all a company setup, right? Where you make a profit or you make a loss. You have expenses, you have income, right? Is this going to push more of those mum and dads towards going, hey, I can't get a 50% discount. I may as well at least use the benefits of a company structure?
And I can't get the deduction anyway. So the company quarantines it. In your own name, you quarantine it anyway. But then subsequently, when you sell the property and the company pays this tax at 30%, unlike with a trust when it makes a profit, you've got to pay minimum 30% tax on it, which you think that's the same, but it's not the same because with a company, you do. If you're in a lower tax bracket, at this point in time, you get the refund on that extra credit that the company has paid.
That franking credit. Yeah. And that franking credit seems to be that last bastion of the thing the Labor government hasn't touched yet. Look, that's something that I think we've glossed over there, but it really starts to signpost from a technical perspective where I think things are going. And we saw it in America as well. We've seen it in Europe where the idea of a mum and dad making money through property investment has dried up. And it's really just those big black rocks, the big institutional companies that own tens, hundreds of thousands of properties. It's really starting to professionalize property development, property investment. And you have these massive conglomerates that own thousands of properties across suburbs. Now, that's not where we are now, but it's certainly one step in the direction away from making property investment in established property, at least, accessible to the unsophisticated mum and dad. It makes it a little bit less incentivized. It makes it more complex. And it essentially pushes people towards professionalizing into that company space.
Look, unfortunately, and let's wait till the legislation goes through, I don't think people should panic right now, but I think it is going to go through the way it's been presented. My best advice is going to be every scenario with people having property, you should speak to your accountant and understand how it will affect you. And if the gains are going to be substantially high because you've had the property for many years, maybe the impact is going to be minimal and you don't have to be too concerned about it. But it's best to understand where you stand with regards to this, and that way you can make an informed decision whether do I sell in the next 12 months or do I just ride this wave and carry on.
One thing we know is that things are never as bad as they seem, they're never as good as they seem, right? This too shall pass, and this will be factored into the pricing of certain properties in certain suburbs and certain types of properties. Is there more of an incentive now if you already own property and it's grandfathered under this legislation to keep the property?
There's two parts to the equation. One, the grandfathering applies to the negative gearing. So if you've got property that you're losing money on, you still can claim that. More importantly, you've got to understand how it's going to apply to you with the capital gain. So that's the more critical part to it.
So what you're saying is that those properties that were purchased pre-1985, which was that CGT exemption cutoff date that we know historically for a lot of the older people, that it will be exempt from 1985 all out to 2027, and then they'll start paying based on an index level. Is that what you're saying?
Basically, yeah. So a person will go get the property they bought for $20,000 back in 1980. It's now worth $800,000. On the 30th of June 2027, you get a market valuation, and then moving forward, the inflation calculation will apply to that property, which previously was always exempt.
Yeah, so wherever you look, none of it's good news. Some of it's slightly bad news, irrelevant news. Some of it's pretty crappy news when it comes to your personal situation and how your current tax rate relates to this. I think the most important factor here, the most critical factor, is actually the minimum 30% tax rate. The rest of it, for me, you should never be investing for negative gearing in the first place. If you've got good property that you've had for a while, it's probably not negative geared anyway. And from a CGT perspective, tax is tax. I want to make a profit. They're going to keep a bit more of it, but it probably isn't going to stop me developing it. It will be factored in over time to the inefficiency of the market in the first place. So it's not going to stop me investing in good property. It's not going to stop me developing good property, but certainly it's just another cost that gets built in to the net position of what we're achieving out of it. And the federal government is going to take a little bit more of it than we would have liked at the end of the day.
And the key to this will be make sure you structure the purchase the right way.
And what is the right way?
It seems to indicate that it's either have to be in individual names or in the name of a company structure. So it's a matter of understanding how those two work, and then you can decide as the individual how you want to move forward.
Carlo, I appreciate your time and I appreciate you clarifying a few of these things. It starts to get really technical. I understand that people might have to listen to this a couple of times to get their head around it. But at the end of the day, my final thoughts on this to everyone listening is that this will not increase the pie. Prices go down when there's more pie to eat than there are people eating. And in Perth, what we know is that there are still a lot of people eating the pie and not enough chefs in the kitchen. So it starts to make the mix different. It starts to push the herd towards supplying property in places on the urban fringes and possibly apartments if they stack up, which they don't at the moment. So most will go to house and land. What it will do is it will make that new supply in infill suburbs probably even more lucrative than ever. Anyone who can get new supply off the ground and look to develop it and then sell it to the market, to maybe an investor who can still be negatively geared in somewhere like an Inglewood, that will be an absolute pearler of a development to do compared to everything else around it, because it will be 1 in 100. So I'd say that's probably where the smart money is going to go, is infill subdivision. If you can get that up, what you'll have to sell at the end of the day will be a diamond in the rough. Guys, thanks very much for listening. I appreciate everyone's comments and questions along the way as to what's going on. We'll be back with some suburb spotlights next week.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!